Hi, everyone, and welcome back to the show. This afternoon, I have with me a wonderful lady called Margarita Pineda-Ucero. She is a business transformation and risk management expert, has 20 years experience at GE Capital, the latter years of which she was the chief risk officer in Latin America for the company. She's also founder of the Women Dignity Alliance and also a nominee director by the IFC to strategic partnerships. Really pleased and delighted to have you on the show, Margarita. Thank you for being here.
Thank you, Jason. It's a pleasure to be here today.
Great. And we're talking about, a number of things really, but modeling or predictions during what is a crisis or where there are a lot of unknowns ahead of you. So sort of modeling, financial planning, scenario modeling, when we have a lot of unknowns around us, when we're in a crisis, when there's, not a lot to go on and a lot of change happening around us. So that's what we wanted to talk about today. Why don't you just give us a bit more about yourself? I've given a little bit there, just kind of where your experience in this sort of matter has come from.
Yeah, well, I've been around for a couple of years, let's say, or maybe a little bit more than a couple, in various regions of the world, in the Latin American countries, Eastern Europe, in Asia, obviously here in the United States, where I'm based now. And have been able to see a lot of things that happen when we are in crisis and in financial services, how we suddenly have to come up with ways to value things. One of the things I did for about 10 years or so was buying non-performing loan portfolios in emerging markets under GE Capital. Okay. And some of the challenges we had at that point in time was obviously, how do you build a model where you can reasonably predict what is it that the borrower of the loan is going to do in a default scenario to be able to collect on those? I connect that experience in certain instances with what's happening today. How do you model things that you don't know what is going to happen, or how are they going to look like? Of course, back then, the economies of the world were different, and some of our premises for assuming what was going to happen in the future were relatively known in certain areas that the models were based on. But in today's scenario, I think it's a bit more challenging than then.
What is the? Can you just talk to us about the impact that a crisis does have on our ability to predict and build those models?
Yes. In contrast from the example I just gave, today, historical data has limited relevance for modeling. The trends and parameters of how things are likely going to evolve in the future are still being revealed to us as we speak. Back then, it was a little bit more certain. The ability to build certain assumptions, but from the historical behaviors that we had observed in certain industries for a non-performing loan, or in certain profiles of borrowers for a non-performing loan. Today, industries have been impacted in a variety of ways that were not evident in other moments of economic crises or even human history, modern human history. So I think the greatest impact to our ability to predict today through modeling is really that our historical data is no longer of relevance or strength than we used to have to work with.
Is that because this scenario we're in is so different from what we've seen before? That historical data is no longer relevant, or is it the timing? Is it that there is some things, some trends that we've seen in crisis previously that maybe we can bring to the table, or is it all bets are off? It's different crisis, different time, different impacts, different time of the world. What is it that means that historical data is no longer as reliable as it used to be?
I think it is that the areas that will be impacted as we go back to the whatever new normal becomes to be are yet to be seen. We cannot assume certain things will happen the way they did before. I mean, think of for instance, hospitality industry, right? Restaurants, hotels, or let's go, all the way to airlines or theme parks, Disneyland, entertainment, certain things that we just don't know what the new normal is really going to look like. Can we assume the same levels of occupation? Most likely no. Can we assume the same rhythm or timelines for their sales to take place, their marketing campaigns to be viable? Are those industries going to go back to operations? Of course. I mean, they are operating already, and they'll do it beautifully because they have smart people there figuring out how. But we just don't know exactly how to model those future hows.
Yes.
Right. So
yeah, we haven't. We're still in the crisis. We haven't got the data point that says what does next look like. So we can't model what next looks like, and there may be some incorrect assumptions in what we think by industry, by region, by country.
Yeah, I think we have some early read trends, Jason, if we want to call it that. We have some sort of recent pivot points on certain industries. And of course, this is delicate to comment because it varies by industry. But there are some reasonable pieces that we know can likely go impacted by a set of variables. And in my opinion, most of what we can do now is sort of identify or break down what are the reasonable pieces known within the unknown that we can run a variety of scenarios for, perhaps, and what are the reasonable possibilities to assume given unclear trends and very murky still potential outcomes. And within those sort of relatively known, reasonably assumable set of values and variables, run scenario analysis, run sensitivities. In my opinion, that's all we can do now, and quickly learn from those, right? Set up processes so we quickly learn from those. But beyond that, I think it will be very risky to try to predict new trends or new parameters for hard code modeling.
Is it also reducing? So I don't know, the time horizon that you're talking necessarily, or where what usually is done particularly in financial risk management and loan portfolios and those sorts of things. But is it more sensible? And are you saying that also sort of do that over a shorter time? Reduce the time period that your scenario models over, or are you saying still model it over the same time period, but just be flexible and adaptable to be able to pivot that model if you need to, if some of those scenarios play out or don't play out?
It's it could be a little bit of both. Because right now, when we are modeling and we're creating scenarios, the freedom that we have is that we can do a short-term approach, and then we can do sort of a longer picture, sort of broad time frame approach, and make reasonable assumptions in each one of those cases. Of course, in the longer term, the reasonable assumptions are more limited. But there are certain key guidelines that we can use. For instance, in advanced economies, most governments, if not all, have came out with support programs, right? For middle market companies, small companies, even the consumer individual. Whether you want to code those from the political perspective, good, bad, quick, slow, etc., that's politicians. We people that just concentrate on the models can assume that those injections of money and sort of timeframes dictated by the actual support programs are there. Emerging markets, most governments have provided very limited support or no support, right? But the economies of some emerging markets are more impacted by that particular country's companies in the supply chain connections of the world, right? So what assumptions can we make from the natural resources, basic productions that are just very individual country centered, and then its interconnections with local economy and economy abroad? And from that perspective, start running those scenarios and rely very much on recent observations. Now we have April to November to build some basic reasonable observations, inventory moves, sales, receivables, collections or uncollected sales, restructured agreements. As I was saying in the supply chain point, if there are connections with the outworld, maybe foreign exchange variations, interest rate variations on those countries where our commercial links are more connected. So there is basic assumptions on GDP growth. And from that, run a scenario, a variety of sensitivity scenarios on those. So there is little stuff to work with because these early read data and shift of patterns has some indicators.
I mean,
beyond that is hard.
It's interesting. You pulled out some other data points that other people make. So sorry, other risks or scenarios that other people make that you use in your own risk model, like predictions on GDP, unemployment rates. So it feels like we could be building on a bit of a house of cards where we're putting risk model upon risk model or sort of predictions upon predictions that are all based on the kind of either human assumption or best guesses. Is that a risk? How do we protect against that, or actually is it that we're all in the same boat here? We know everyone's making the best prediction they can, building the best model they can, and just be conscious to it and be flexible around it.
I don't think we have enough information yet to adjust our models. We have enough information to start making some fine-tuning with these early read data and these early read responses. And from that perspective, I think the human touch is critical. Because we can have, for a change, humans actually monitoring what the models are producing in a closer way than we used to just this time of the year a year ago, right? Shift a little bit and rely a little bit more maybe on this human touch around our models. I think that's more critical versus pure reliance on artificial intelligence. Certainly, machines will take a little bit longer to learn the new realities and the new patterns than humans will be able to react to models that we have now and make the quick adjustments, right? Is it going to be perfect? No. It almost never is. Is this going to be the case to then remain stable and don't do anything beyond that? No. But it's a quick, good, in my opinion, immediate reaction to implement preventive measures from what may be coming on the unknown than just being reactive to a model that took us in a different direction because we didn't step in. Better predict a little bit wrong, but step in quickly than have to react once maybe a decision was made or a trend was taken into another direction, just because our models shifted things without a human touch.
What can't models do that humans can? What can't a machine do? What is it about the human touch then that means that might be a better or at least not necessarily a better way to go, but at least a slight variant on how we may have done things before?
Yeah, I think we humans can learn a little bit faster than the models. Of course, we learn with less variables and reduced complexity than the models. So that's sort of, the which way do you go at every step of the path. But at this current time, I think we can react faster with humans, and we can learn faster on the quick things, redirect, and then go again and again, right? We can also have models overseeing models, and then a human seeing what's happening. So for the complexities that the human on a standalone basis wouldn't be able to see, we can break it down into, 2 or 3 models overseeing other models, and then the human sort of making common sense calls on the actual output. I know this sounds maybe a little bit too, artisan driven, but that's what you do in moments of crisis, in my opinion.
Yes, the reality, isn't it? Has this changed? I mean, it sounds like you're articulating and I apologize, I don't know the market of risk modeling too well, but it sounds like you're articulating something different. This isn't how it's been done before. This is this is sort of slightly uncharted water. So I suppose the first question is that true? Is this uncharted water that risk modeling, financial modeling is in? And then also, which I can re-ask the question, but do departments, organizations need to set themselves up differently to cope with this new way of working? So just feels like there's something different here, and we might need to do something different and set ourselves up differently. But yeah, how different is it, is the first question.
Yeah, to your point, it's not uncharted scenario in terms of risk modeling or what we've seen in the past. I think what is really different is that we have less historical data points or historical references to, in a high level of comfort, predict with a model what would be the likely behavior or what would be the likely resolution of a particular situation in that portfolio or in that financial budgeting, planning, etc. But what we can do, which we've done in other instances when facing uncertainty for modeling, is sort of review the data gathering processes that we have for our models to run.
Right.
Simplify versions of it. So maybe we use less data points with a little bit more diminished certainty of prediction, but a greater spectrum to make considerations. And that's why I was alluding to the human touch versus a more automated sort of artificial intelligence touch that is the norm today. It goes more to, those times, as I was referring, when we were buying the non-performing portfolios. I mean, I'm talking, late 90s, early 2000s. Maybe some in your audience would be like, oh gosh, this old lady. But, we didn't do it with very sophisticated models like the ones we have today or artificial intelligence. We did it a little bit the way I'm describing just now.
Right.
And it seems to me that it's very trendy today to bring that thought again and build from those lessons. One of the challenges is that those of us who did it back then, maybe today retired or just giving opinions high level, but not really with our hands rolled over to get on the models. And that's why I'm enjoying tremendously this new time of things, because it just reminds me of when we were doing those things sort of more manually, and yes, relying on the models and the infrastructure supports that we had, but bringing a lot the human aspect of it and the sort of common sense on top of what the model would show.
It sounds like kind of almost going back to first principles of managing risk and building predictions and scenarios, and also simplifying. I think you said this even, so simplifying the models. And I imagine, again, in my naivety in risk management, I imagine the models have got very complex over the years. Multiple data points, and as technology's got better, as you say, artificial intelligence. The predictions have got more data points, and because you do, and you refine. But are you kind of implying that those models are almost too complex and too intricate now to deal with these unknowns, that stripping back to, instead of 20 data points, to 3 data points, and then relayer on those data sets sort of as you get more confident in the prediction or the scenario that you're producing?
In a way, I think it's what I'm suggesting. It's a thought, and I would be so curious to hear what people in the audience think about this. But the core of what needs to be done, whether we go for a heavy simplification route and sort of reiteration, or not so heavy and more light, dependent upon the industry and what are we modeling. What I think it's an imperative for everyone is to have a clear understanding of the data infrastructure of our models.
Yeah.
Not always do we keep across the board, especially when we're making decisions on how to shift assumptions or outputs of the model. Not always do we have a solid understanding of the data gathering process and the data infrastructure around it. And as we know, the delicacy of doing this is that when you shift an assumption to modify the output of expected trend or a pattern, if the data interconnections in the model and certain other assumptions are not well taken care of, or the frequency at which the data is gathered for those outputs to be produced is not carefully reviewed, we can be thinking we're simplifying the model, and indeed we're just disrupting its service, right?
Filling it with poor measures or metrics or information that just skew your result.
Exactly.
And that, I mean, that's a challenge for all metric, all reporting, all data, all analytics that needs to be done, risk modeling, financial scenario planning, or other. But is there a thought here then that all of this, yes, lots of unknowns, more uncertainty, does it mean that we just have to accept, or risk modelers, risk managers need to just accept that there is now more risk? Or actually, are we saying that we accept more risk? Sorry, there is more risk, we accept more risk, or is what you've been talking about helping to bring the acceptable level of risk that we apply, or the direction that the model goes? Are we trying to bring that back to what is normal, if I can use that word? Are we trying to kind of get to a normal through these approaches that you're talking through, or are we just accepting, in the time that we're in right now, whilst there's still so much crisis around and uncertainty, that there is just more risk?
I think the actual risk challenge is not as much in quantity of risk being, more risk or less risk. I think it is in terms of approach to managing risk.
Right.
We got very comfortable with one approach based on historical data, certain assumptions, certain, repetitive patterns and trends that vary dependent upon certain intrinsic and extrinsic variables that were relatively known across all these risk models. And I'm making a big,
it's
generalization. Of course, we all know each case, it's a story in its own, but let's just sort of at a very high level, sort of almost philosophical level model speaking and risk management speaking, that's what we had.
Right.
What we have today is a challenge to continue to manage that risk that we've always managed. For instance, in financial portfolios, giving the money to someone who can actually pay it back at a premium to the financial institution in its most basic representation, right? So that risk is there. But what are the variables now that would be drivers, maybe of paramount importance in the assumption of those monies coming back that perhaps were not in the past?
Right.
I don't know. For instance, we never asked the question. I'm going to say something that's going to sound, crazy, but just so to illustrate the point. In a credit analysis scenario, we never, for instance, asked to a customer, "Are you healthy? Did you get such and such vaccine?" I'm not suggesting this is going to be part now of, the credit questionnaire, but it's not out of the question if you are in the midst of a pandemic and you don't know the level of health of this person. Are you intruding in the individual's personal data and personal privacy to decide if you give him a credit or not? And now I'm talking consumer lending, right? Not commercial lending, which is where I started the conversation at the corporation level. But there are certain questions, and again, this is just an extreme example that we never asked before. And perhaps as risk managers, we have to think, what are the additions to my approach so I can continue to manage risk? But now in this challenged approach, in this challenged moment where my approach needs to be shifted. I don't know. Am I making sense to you?
I think what's key there is that, so you've talked about going back to some first principles. We've talked about potentially some simplification. We've talked about you need a good data infrastructure that's giving clean data into your models so that you've got, removes one area of potential sort of failure of the model, I guess. And now you're talking about, and whether that example comes true or not, but you're talking about looking almost outside of what was traditional in terms of the inputs to those models and the things that drive, a yes or no answer or the one direction or another, or one scenario over another, and saying, what else is there? What other ways can we think about the future that we haven't thought about before? Sort of, thinking wider than the box you've been thinking in previously. I think that totally makes sense.
To bring it back to the basics, though, and very landed into reality today, now, next steps, I would just say, identify the reasonable pieces of your known elements. Identify the reasonable possibilities within the unknown, and then run scenario analysis, various sensitivities with the early learnings, early read of variables that have been impactful over this last few months, and take it from there. And then, sort of run these maybe a little bit artisan process as we get into points where things are a little bit more stable, to start making slightly longer term predictions with data that feels reliable. Or that seems reliable.
Well, I think that seems like a fair and pragmatic approach. That's probably a good word, a pragmatic approach to it. And what else can you do? So no, that's been great. I appreciate your time on the show. I think we've unpicked that. And I know, interestingly, we've been talking mostly about sort of financial risk modeling and institutional risk modeling and financial modeling. But I actually think this is quite applicable on any level of sort of scenario planning of algorithms, of models that have used historical data. How do you, even if you're predicting a next best action for a customer in a retail business, or predicting demand for a certain product line, the same challenge applies. The history is different, the customer behavior is different. So I do think this is relevant across any kind of prediction or scenario modeling that we're doing. So I think it's been fascinating. So thank you, Margarita. I really appreciate your time.
Thank you, Jason. It's been a pleasure being here today, and I'm looking forward to our next conversation because there's so much more to
Absolutely.
talk about this and see what happens.
Yeah, brilliant. Thank you very much. And thanks everyone for listening. We'll catch you again soon.